mind, looking for a dime. James Locke in the house, gonna help you shine.
Hey, welcome everyone. Welcome to the Poole Locke YouTube channel. I'm James Locke, and today we're going to answer the Ask James questions of the day. So we have this question from Jan, and she says, if inflation is calming down, when can I actually expect prices to calm down? Jan, that is an excellent question about inflation and its correlation to prices. It's crucial to understand this relationship, especially when planning for retirement income. Unfortunately, unless we experience a severe recession, you're unlikely to see prices actually come down. So let's break it down a bit more. So when we say inflation is calming down, we mean the annual rate of price increases is slowing. It doesn't mean prices are reversing. So think of it like climbing stairs. Prices go up, then plateau for a while, then go up again, then plateau. What we're hoping for now is that we've reached one of those plateau periods. A scenario where prices actually decrease is called deflation, and it's typically associated with severe economic downturns. So this is not something we generally hope for, as it often comes with other economic challenges like job losses and reduced economic activity. So the best realistic scenario we can hope for is that prices stabilize or that kind of the rate of increase slows significantly. This is why the Federal Reserve aims for its target inflation rate of about 2% per year. Now, how does this affect retirement planning? Well, here's a few key points to consider. Consider your income needs. Your retirement income plan needs to account for gradually rising prices over time, even if inflation slows down. This means your income sources need to grow or at least maintain purchasing power. Always consider Social Security. Now, fortunately, Social Security benefits have a cost of living adjustment, COLA, that helps maintain purchasing power. However, these adjustments don't always fully cover retirees' increased expenses. Keep investment strategy in mind. A retirement portfolio should include some growth components to help offset inflation over the long term. This could include dividend-growing stocks, real estate investments, treasury inflation-protected securities. Those are called TIPS. Another thing to consider is budgeting. Now, as you approach retirement, it's crucial to reassess your budget regularly. Prices for different goods and services inflate at different rates, so your personal inflation rate might be different from the national average. Focus on healthcare costs. These often rise faster than the general inflation, so it's important to factor this into your retirement planning. Look at fixed income investments. Now, in a low inflation environment, interest rates tend to be lower. This can affect the income generated from bonds and CDs, things like that, requiring careful planning to ensure adequate income. So there's some good news, Jan. Over the past few years, wage increases have largely kept pace with inflation for many workers. So while this means people haven't seen real increases in purchasing power, it has helped prevent a decline in living standards for those working. Now, if you're still in the workforce and inflation does level off while you continue to receive pay raises, that could mean extra discretionary income. This prevents an opportunity to boost your retirement savings or investments. Now, for those already retired, it's important to have a diverse income strategy that includes some inflation-protected components. Now, this might involve a mix of Social Security, inflation-adjusted annuities, dividend-growing stocks, and periodic withdrawals from diversified investment portfolios. So remember, retirement planning is about maintaining your standard of living over the long term. While we hope for periods of price stability, it's prudent to plan for continued, albeit hopefully slower, price increases over time. Regular reviews of your retirement income plan with an income specialist can help ensure you're staying ahead of inflation and maintaining your purchasing power throughout retirement. Jan, great question. Thank you so much. Hey, if you would like to send in your question, you can do so by emailing it to poolelock@poolelock.com. Now, our second question today, and that comes from James. Great name, James. I love it. We Jameses stick together. So James asks, you might be disappointed to hear this, but I've really been postponing transitioning to income even though I should, because I've been making way too much money in the stock market. So is this really a bad strategy? Well, James, I appreciate your honesty. And we're income specialists here, and I understand your perspective. It's not disappointing to hear you've been successful in the stock market. However, it's important to consider the risks of this strategy as you approach retirement. Well, let's break it down. Market timing and luck. That's the one thing to look at. Your success so far might be partly due to fortunate timing. Interest rates have remained high and certain stocks have continued to climb. But remember, market trends and cycles are unpredictable. We never know when a trend will end. You need to look at historic perspective. Consider the late 90s as an example. There were pullbacks in August and October of 1998, followed by about 15 months of exceptional growth in tech stocks. Now, many investors who thought they'd kind of missed the boat then got ultimately caught in the subsequent dot-com crash. So you gotta be careful. But, risk increases over time. As you get closer to retirement, maintaining an aggressive growth strategy becomes increasingly risky. You're in, if we're in the late stage cycle of an investment timeline, the question is whether we're at the beginning of the end or the end of that late stage cycle. And really nobody can answer that with certainty. But there are economic cycles. Typically, the next step after a prolonged bull market is economic contraction. So when this happens, tech stocks and small cap stocks often pull back more sharply than the large cap and dividend paying stocks. When the Federal Reserve starts lowering interest rates, which are expected to do, transitioning to an income-focused strategy later means you might be locking in lower yields. You risk being hit on both sides, potentially having less capital due to a market downturn and then getting lower income yields on what's left. So you should look at transition strategies. Instead of an all or nothing approach, consider gradually transitioning your portfolio. You could start moving a portion of your assets into more income-focused investments while maintaining some growth exposure. Diversification is key. Ensure your portfolio is well diversified across different sectors and asset classes. This can help mitigate risk while still allowing for growth potential. Look at income-generating growth. Look into dividend growth stocks or real estate investment trusts, known as REITs, that offer both income and potential for appreciation. Do a risk assessment. Reevaluate your risk tolerances. As you near retirement, your capacity to recover from significant market downturns diminish. Retirement income needs. Check those out. Calculate your expected retirement expenses. This can help you determine how much your portfolio needs to be in stable income-generating assets. Keep behavioral finance in mind. Be aware of cognitive biases, like recent bias, where we give more importance to recent events, like current market gains, when making decisions about the future. Always go with professional advice. Consider consulting with a financial advisor who specializes in retirement income planning. They can help you create a personalized strategy that balances your need for income with your desire for continued growth. Remember, the goal of retirement investing isn't to maximize returns at all costs, but to ensure you have a stable, reliable income stream that lasts throughout your retirement years. While it's great that you've seen substantial gains, it's crucial to protect those gains as you approach retirement. So a balanced approach might involve securing enough income-generating assets to cover your essential expenses in retirement while keeping a portion of your portfolio in growth assets for discretionary spending and to combat inflation over the long term. The key is finding the right balance that allows you to sleep well at night, knowing you're not taking unnecessary risks with your retirement nest egg, while still participating in potential market growth. So it's not about timing the market perfectly, but about transitioning to a more conservative income-focused strategy at a pace that aligns with your approaching retirement date and risk tolerance. Hey, great questions as always. Thanks for these awesome questions. And if you'd like to send in your question, you can do so by emailing them to poollocke@poollocke.com. If you like what you heard, go ahead, like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you guys soon.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.